Yeah, we are live, ladies and gentlemen. Shake my hand. If you're watching on the live stream, shake my hand. Just let me know if we are audible. Let me know if I'm audible. If you can hear me, I would appreciate that. Just quickly doing a refresher here to see what we have in store, right? Let's check it out. Right. Good evening. Boom, 75 basis points. According to my maths, to me, if the focus was 2,5 and we got 2,5, that means we got a 75 basis point rate hike. All right. I just want to double check that with the headlines, but I'm pretty sure that's what that means. Please do let me know if I'm audible. Can you guys hear me before I start? Can you hear me? Can you hear me? Hope you guys are doing well. Good evening. Today is a big day for the markets. Well, the first half is now done, right? We now have what clearly is a 75 rate hike by 75 basis points. And that's what the markets expected anyways. I want to move on, but I just want to make sure I do a mic check. Can you guys hear me? Can you guys hear me? Yes. Okay. Mama Eunice, good to see you. Fantastic. Right. So, I mean, there's not much we can do except react to what Powell has done, right? So FOMC has voted to maintain a 75 basis point rate hike, which is what they said they were going to do in the last meeting we were here together. So what I want to do in the next 29 minutes we have together is just explain a couple of things, break down what this means, break down a few charts, right? And then at 8:30 p.m. in about 30 minutes time, we are going to live stream the actual press conference where you will hear for yourself what Powell's going to say. I'm very interested in the direction, all right, of the market. I want to highlight a few things that you guys should be aware of so that when the questions are happening, you know that this is important. How he's going to answer is important. And obviously, we're here to know how this is actually going to affect our trading. And those of you who are investors as well, our investing. I'm a crypto and stocks investor, tech stocks specifically. So all of this affects everything to do with financial markets, my trading strategy, my investment strategy, short-term to medium-term. So all of that's going to happen in 30 minutes time. Right. So, and to get it out of the way, there was a little bit of fear, in the market space for the last, give or take 3 or 4 days about potentially, the Fed, giving the markets a bigger rate, right? 100 basis point. And I think had that happened, we might have seen some interesting movement in the dollar. I'm a big DXY fan. I trade a lot on the dollar. I also trade Euro USD quite religiously. And had we received the 100 basis point, which is something that the market had not priced in. So far, the market has been doing a very good job of pricing in what Powell says, as long as Powell meets that expectation, right? We had the 25 basis point rate hike in March, then we had 50 basis point rate hike, then we had a 75 in the last meeting and another 75 in this meeting. Another thing to note, there is no meeting in August. So what Powell says tonight needs to hold the market for a very long time until we all meet again on these live streams in September. All right. So it's actually, frankly, quite a big deal, right? So I've been trying to get a whiteboard running in the background, but I don't think that's going to happen anytime soon. So I'm just trying to figure out a way to kind of like portray some notes that I had for you guys. But if not, I would then talk around charts. I have no problem doing that. And just give this thing in the background one more try. Right, fantastic. There we go. Right, so I'll be sharing with you guys my whiteboard in just a few minutes, or moments rather, as soon as this thing allows me to. 2 seconds. 2 seconds, everybody. Right. Okay, so I've got a whiteboard here. Right, so we're going to look at charts tonight before the press conference. During the press conference, I'm going to focus on the dollar and maybe NASDAQ or S&P 500. Personally, I will not be trading during this live conference feed. Personally, I will not be giving out signals for you to trade during this live press conference feed. This is not a trading moment. This is just market volatility, market uncertainty, market fear, market happiness. It is not a good time to trade. I was and am in Euro USD. I've already broken even. There was a buy at one of the H1 demands that markets missed me by 1 pip last night at 7 p.m. Price since now, 24 hours later, has come back, tagged me on the buy and gone up, 25 pips, give or take. Right, I've broken even from that position. I cannot lose money on it, but I will not be actively making any trades there. Why? Because, well, I never trade during live news events. I mean, why bother? Right, so a couple of things that you need to look out for in the next 30 minutes when Powell speaks. Right, number one, some experts are calling it, the Powell curve. I'm going to avoid using that word because it means nothing, right? You need to be aware of the fact that the Fed has the ability to push us into a recession forcibly, all right? And this really was something to really take note of, especially if we got the 100 basis point, right? We didn't get the 100 basis point. We got the 75 that we expected. I believe, I'm one of those people who believe recession is already here. Tomorrow, Thursday, a very big market day, by the way, the GDP numbers are going to come in. All right. Now, the GDP is going to tell us if the second financial quarter is also contracting, if the second financial quarter is negative. Textbook definition of a recession is 2 back-to-back financial quarters in the red. This is very important because as we speak right now, President Joe Biden, right, old man Joe, and his administration for the last week or so have been working day and night to try and change the definition of a recession. The government is trying to get a new type of recessionary definition. I see there are comments there. Shake my hand, everybody. Thank you so much for the feedback. Good to see you guys. Right. And you must be very careful about that. What the government says is not what the markets are saying, and what the markets are saying is the only thing that matters. Today is Wednesday. By end of this week, Friday, I will have put together all the lies the government said in 2007 before the great crash of 2008. There was confirmation upon confirmation from experts, the FOMC of that time, the government itself, telling people there is no recession, there is nothing to worry about, markets are doing perfectly fine. I've asked a lot of people to watch specific movies around these ideas, but I will put together headlines from the Wall Street Journal, right, but before the end of this week, so you see for yourself. Now, Joe wants to say the recession is actually, and I'm talking about Joe Biden, the president, and the whole White House. Their definition is there's going to be a special committee that sits down, and the special committee has to do a lot of data collection, a lot of research, and it can take anywhere between 4 to 14 months before that committee comes back to the people and says, yes, we are in a recession. That is too late, all right? Trust me on this. So please bear in mind that tomorrow is a big day for the markets again. Right. Today's volatility is not enough. There'll be more movement tomorrow as we get those GDP numbers. But tonight, if anyone in the press asks Powell, what do you think about GDP? Pay close attention to that answer. Because what those guys want, what the markets want to know is, dear Mr. Powell, you are the governor, you are the Fed chair. What do you think is recession? Is it the GDP definition? If Powell gives us a straightforward answer to say, well, it's 2 negative, financial quarters, then that is it. If he gives us a politician's answer, it means he's seen the numbers and he's just fluffing about to keep his job, right? So that's something, please, you need to keep mindful of, right? The second thing I want you to kind of like bring in mind around this recession thing is just a further confirmation, right, that Powell so far, right or wrong, like him or not, is kind of sticking to his plan, right? You recall, sometime in March, Powell said recession wasn't going to happen, right? He literally said there'll be no recession, no matter how you define it. The financial quarter definition that I just gave you guys, the Joe Biden definition, his thing was, as long as we maintain a hawkish path, keep increasing the interest rate, right, we can push recession back. Tonight, we want to know if he still stands by that. And tonight is important because once again, the month is now July. we have CPI data that shows us, right, that potentially inflation is peaked. And by peaked, I'm not saying I agree with that. It's just what everyone is saying, which is at 9.1%, highest inflation reading so far. And a lot of experts, right, are advocating that inflation has finally peaked. Now, do we believe them? Do we not believe them? It doesn't matter. We need to focus on where the money is going, right? The money, just follow the money, supply and demand. When I say follow the money, I'm talking about supply and demand. If you don't understand supply and demand, there's a link down below somewhere there. Register for the course right now and take my full master trading supply and demand course to understand that. Because it is the only way you can track the truth, the only way you can track what institutions are doing. Now, what Powell said GDP about recession is absolutely important because he was the shield. He literally said, if I keep increasing the interest rate, 25% basis point, 50 basis point, 75 basis point, another 75 basis points today, right? That's 4 interest rate hikes. We should see recession go away. We should see inflation come down. And the CPI numbers of August and September are going to be the most important because somebody has to justify if for sure this thing has peaked, right? So we want to hear his thoughts around that, right? I need to rush because of time. Right, and then we want to talk. I'm talking about the GDP thing happening tomorrow. Right, so that's kind of like the main thing. What I will put out, because it's very important that I not only bring out my bias. My bias right now in the market is very bearish. I'm not much to say that in today, even if the world believes inflation has peaked, I'm still bearish. Right, until I see quantitative and qualitative numbers in buyers in the market space. I'm still looking at retail capitulation. I'm still looking at stocks falling right now, right? At this moment, what Powell will say tonight might change my perception, but my perception is not enough for me to go risk money in the markets. After my perception is changed, I'm going to go look for that bias on the charts. And what I want to see is demands taking control or about to control. But I want to bring to your attention a couple of things. There are those people who believe that, number one, inflation has peaked, and they might be right. Okay, so I want to give you guys the other perspective, 9.1%, and they believe that moving forward, CPI data starting to drop. If CPI data starts to drop, then they are right. Inflation has peaked, right? This same group of people believe, and the data actually is agreeing with them, right? Some commodity prices are starting to fall. So oil has been below 100 US dollars. In fact, I was in a today under 100 US dollars per barrel. There are many other commodities that are starting, at least in the United States. And so the combination of inflation peaking, commodity prices dropping, is also spelling out another piece of data that I know retail trade focus. Maybe I should channel, right? But it's called consumer confidence, right? Consumer confidence is starting to grow again, according to these experts. Consumer confidence is a simple thing. Consumers have cash. Because they have cash in their pockets, they spend. They're not afraid to spend because the price is fine. Price because it's going down. That's the basic argument. That's Group A in the markets right now. Group A are bulls. B to be how these points. If Powell says this stuff just and reiterates it and massages the economy, talks about NFP, talks about growth, talks about good job numbers, etc., then I guarantee you markets tonight and tomorrow maybe will run, right? We're going to get a slight bull run. We're going to get that excited group going. Yes, all these things make sense. And now the FOMC is agreeing with us, all right? That's one perspective. The other group, and this is really kind of like the group that I belong to, looked at a couple of things. As much as all of this is true, and it's really happening, they were kind of say on Tuesday I took the day off because I had to literally sit every report off. Walmart, right? These are big companies. And let's start with Microsoft. Microsoft is a big tech company, right? Microsoft had a soft landing and not so great earnings report. And what that means is their shareholders not going to get paid a lot because right now business is not doing well. And if business is not doing well, you can't get paid a lot. So that's for the shareholders. But what that means for the economy is the consumers are not buying our products because the consumers are a little bit shell-shocked, right? The inflation is hammering them, which challenges this idea. If consumers are not buying products, are not buying iPhones, are not buying, Apple, are not buying Microsoft, blah, 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 it actually challenges this narrative of consumer confidence and that everybody has money and people want to spend money because the price is right? So Microsoft came in saying, we didn't find that with our particular markets. The next group was Walmart. Now, Walmart, if you're in South Africa, the best example of Walmart is ShopRite, right? Now, if you're in South Africa, you know ShopRite. I guess it depends where you are, but in most cases, ShopRite is that brand where the working class of our society, the poorer people, go and shop, right? So technically speaking, it's a growth stock because it's a cheap stock that everyone can get into and it caters to a very big, large group of people, right? Walmart is like that in America. It is literally the store for the middle class and working class people because all their prices are wholesale, they are cheap, right? So everybody should potentially, in a fair world, be able to afford their products. How much is the cost in USD? I want to say $200 US. Someone is asking. It's sad that I don't even know this, but I think it's $200 US upfront. And then if you use a payment plan over a period of 1 or 2 months, you end up paying $250 US, right? But please double check me on the link down below. All right. Thank you for that question, Washington. Right. So when Walmart came in, Walmart shocked the markets because Walmart said, don't forget, our customers are like the people go to ShopRite. If you're in South Africa, I mean, I don't know how many other people are watching from different countries. What happened to my camera? Is my camera gone? No, it's there. Right. So he said, look, man, don't forget that the people shopping at Walmart are the poorest of our society, so to speak. And we found that consumers are struggling. That's a red flag for someone like me who already has a bias as a bear. Consumers are struggling. They're not buying as much. In fact, Walmart told its shareholders that we expect a massive price reduction. We need to clear our inventory because we think things are going to become even worse towards the end of the year. Right? So you've got these two narratives in the markets. That's all I'm saying. And these two narratives are going to create sentiment. That sentiment is going to create what we all understand to be somewhat of a fundamental shift, and then money is going to choose a winner and supply and demand will take over. All right. So what Powell gives life to tonight matters between these two camps, right? Shopify, I don't know if you guys know about Shopify. It's the last example that I'll give you because I really want to look at charts, before Powell starts to talk. Shopify was this amazing, invention. People called it the boom of e-commerce. Shopify is pretty much how we live in this house, right? Everything of ours is delivered. Or Take-A-Lot is not Shopify, but basically it's e-commerce where you order things online and it gets delivered, whether it's a book, a toy, electronic, a cell phone, blah, 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 buying stuff online, e-commerce. Shopify reported this week that they're laying off 10% of their workers. When a company starts to lay off, things are bad. That's recessionary. That's all recessionary pressure. And Shopify actually said, look, man, e-commerce boom is actually slowing down. Remember, e-commerce exploded in 2020 because of COVID. Everybody was in lockdown. Powell was printing a lot of money. You were getting money for staying at home, getting money for being a woman, getting money for being unemployed, right? It was quantitative easing. That's what caused the inflation. So everybody had money and everybody was just buying on Amazon, buying online, buying on Take-A-Lot. Now, these guys are saying we've seen a tightening as those prices, gas, food, all those things go up. The consumer is now crippled, right? So these are kind of like the things that I want us to kind of like, bear in mind. If you're a bull, this is the kind of stuff that you're looking forward to. This is the kind of stuff that you want, to kind of like see, and hear Powell talk about. If you're a bear, you want the opposite. If you're in my public Telegram group, I did put out a chart the other day. I don't think I'll be able to access it right now only because of time. But I think I showed you guys historically what these meetings look like. Every time Powell speaks, sorry, maybe let me just try and quickly share it here with you guys if you can see this with me, because it's actually very cool, right? This is a public Telegram group, it's a free group, you can join, right? So this is literally all the rate hikes that have happened this year. In March, we had a 25 basis point. The markets rallied like crazy. I remember predicting, a bottom of the 14th of March somewhere on my YouTube channel. But the markets went crazy. This is NASDAQ, right? This is all NASDAQ daily chart, right? So and I'm using NASDAQ because it's a tech, a stock basket, so it's very sensitive, right? When things are bad, it's thrown away, right? No one cares about tech when things are bad, right? And you can see when Powell had the first, Dr. Francis, I saw your private message, sir. I promise to respond to it at least by tomorrow. I'm so busy. I'm so sorry. Sorry, man. Sorry. I haven't gotten around to responding to private messages, but good to see you, man. Right. So the 25 basis point that happened, which was the first rate hike this year, all right, markets rallied like crazy because, yes, as much as the interest rate benefits the dollar, it actually is designed to punish the stock market. I'll say that again. When interest rate hikes happen, they are meant to strengthen the currency, a safe haven flow, and punish stocks. So that's why you see NASDAQ a long-term downtrend, right? The more interest rates we get, the more downturn stocks go. But this rally was because finally the Fed was doing something about inflation. Do you understand? So the markets were like, we don't like interest rate hikes in general, so we're going to drop. But before we drop, we're going to up. But finally, the Fed is taking inflation seriously. And then, the next rate hike was 50 basis point, which is more than the first one. And look at the rally. It was only 3 days. Markets continued down. In June, we had a 75 basis point rate hike, and markets have been slowly trying to range and climb into some type of a supply, although they've created a demand, give or take, and I'm sure this was tagged sometime today. And so here we are now on this tech stock, and this is where we are in the markets, and we're about to see what's going to happen, tonight. And I'm a little bit excited about that. Whenever these things happen, I feel like that kid, when I was a kid, and you had no choice but to get excited over wrestling. That's what I feel is about happening in a few minutes. Right, I've got 7 minutes left with you before Powell talks. I want to quickly talk to you guys about what I found in the COT reports. We won't have time to break all this stuff down, chart by chart like we normally do, but it's just a good indicator just to show you how paralyzed smart money is right now. There is a little bit of movement in the markets, but for the most part, markets are just chilled, right? And remember, the COT reports actually cover real-time data, or at least 1 week behind, but real data on the orders, the order flows. Follow the money. Support and resistance will not make you a profitable trader. Indicators will not make you a profitable trader. You have to have a strategy that maps out where institutions are buying and selling because the market belongs to them. That's why we use supply and demand. We use supply and demand and good market research. So now in my COT findings, I found a couple of things interesting. This I won't waste time with because I've covered this so many times with you in the war rooms, right? Gold. In the last few weeks, we've seen time and time again, gold is dropping. I was in a gold sale. I made that public. You guys saw it. You guys, if you're part of the war rooms, you would have seen it as well. Gold has been falling nonstop, and I don't think that's going to stop anytime soon. Let me quickly see if I can show you guys the gold chart here. My biggest mistake was I forgot to get myself something to drink. I might have to get up during the press conference and everyone's on the other side of the house, so I don't even think they'll hear me. But yeah, we'll see. Right, so this is gold on the day. I mean, we spoke about this. Every Sunday, I give out free signals, free trading signals. So I map out areas of value. We've been selling together. I hope we have been selling together all the way up here when it comes to gold, right? All the way up here sometime in June. Those of you got in earlier, but this was a very big sell for us, and we only exited quite recently. Myself, maybe about 3 or 4 days ago, somewhere down here at demand, right? Gold currently right now is retracing, all right, and it is my, I'm using my words very correctly. It's a retracement. This is not a gold bull run. I don't think gold is about to do something crazy. I truly believe we've got some retracing, and I feel like we're going to feel some orders there, right? So I will be looking to start selling gold around about these levels, 1810, somewhere there, 1810-ish on smaller time frames. On the bigger time frames, this is good enough for me, right? But this is a very potential nice place to catch gold to the downside. As this retracement happens. Retracement is working in line currently with what is going on with the dollar. You'd have heard me in the war rooms on Sunday covering the fact that DXY is in a big supply, and we expect to see some sell side pressure, right? Oil, nothing too crazy is happening in oil. Granted, I did give you guys a free signal on the public Telegram group that went well. We had a short-term buy and a short-term sell in oil right now, but for the most part, nothing major is happening. That's why those guys who are bulls are saying, look, man, oil is below 100 US dollars, inflation has peaked. Maybe it's now time for markets to get back to however they were, right? But there is a weekly range taking place. Now, I expect this range to last for a very long time. I'm talking 1 or 2 financial quarters, right? And let me quickly show you the range. We've got 3 minutes left, so I won't be able to go through all the COT data that I put together for you, but it's fine. I'll do another video during the week. I have so much to show you this week. It's actually incredible, right? It's just time, guys. You need to pray that God gives me 28 hours in a day, right? So this is oil. Now, on the oil chart, I'm just going to quickly move to the weekly time frame. I want you to see it. I really want you to see this. Absolutely fascinating. Absolutely fascinating. What's going on? Right, there we go. This is oil on the weekly time frame. You see here, somewhere here, 365 traders, this is actually quite a crucial area for us in terms of supply and demand trading. A demand was created, but the context of that demand, look at the date, 21 February. That's when that crazy war starts, right? War starts on the 24th or something like that. But anyway, it's that Ukraine-Russia stuff. And ever since then, ever since February, if you look at oil, I mean, I was actually quite happy to pick this up, sometime last week. Ever since then, oil has just been in this weird box. This is a range. This is an annoying range, and I'm pretty sure this range can continue for a very long time. If there is a breakout of oil to the downside, first of all, that would be very interesting, quite the miracle for economies across the world, right? But it's highly unlikely right now, my humble opinion. My opinion is we are going to have a range in market for a very long time. So towards the end of the year, October, November, December, something to kind of like look out for, right? So that oil doesn't really make a big decision, and they do that on purpose, right? So I can close these tabs because we now know what the rate hike is, and it's 8:29. So very soon I'll be handing over to the man of the hour, Mr. Jerome Powell. By the way, thank you so much for tuning in. Thank you so much for enjoying or being here. Don't forget to hit the like button. It helps the algorithm. I was away for almost 3 weeks, and the algorithm thinks I'm dead. So I really need you guys to kind of like, what is going on. Is this how the press conference starts? Because I always arrive quite late. Please do like, please do share, please do subscribe. But I think the press conference is about to start. So if you're new to this kind of stuff, I will let Powell speak as long as he's clear and I don't think he's saying things that are too complicated. I will not interrupt. If you see me interrupting, I will pause the live feed and break down real quick what was just said. The reason I do that is I don't want to leave anything to you guys to guess, right? I just want to make sure we're all on the same page. These guys promised that they'll be done with network maintenance, a long time ago, but I can see my internet is struggling. How unfortunate, right? So we'll see how it goes. Right, so once in a while I will pause, but for the most part, it is really, truly just for your own benefit, right? Okay. Can someone confirm as it started? Someone with better internet than me tonight. I'm actually on fiber, believe it or not. But they did send a message saying they were doing maintenance for the next 24 hours. It would be disappointing if we never get around to it. Can someone just confirm if this has started while I see what I can do about my internet? Yeah, it's about. I don't know what's going on. I'm even still live. How disappointing is this? This is crazy. It's not even rebuffing. At no point complaining because he told us that they were doing maintenance. I just thought that'd be done by now. Sorry, guys. I mean, I've refreshed like 25 million times. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past. What happened? Someone doesn't want us to win tonight. Could you guys hear him, by the way, while I try and wait for this thing to rebuff? 2.5 years and improved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 3%. It anticipates that ongoing increases in the target range for the federal funds rate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. I'm going to pause right now because he said something important, right? So he said consumer confidence has softened. When they say softened, it means it's gone down. So people are not spending, right? So he's attacking that bull argument that, look, man, actually consumer confidence has gone down, right? So growth in consumer spending has slowed significantly, right? So they even subtitled it. Activity in the housing sector is weak, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these
vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread for workers at the lower end of the wage distribution, as well as for labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Continued strength of the labor market suggests an underlying factor. Inflation remains well above 12 months. For 4.7%. In June, the 12-month change in the consumer price index came in above expectations at 9.1%. Notwithstanding the recent economic activity, aggregate demand appears to remain strong. Trends have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Where some commodities have turned down recently, prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and upward pressure on inflation. The Fed's monetary policy actions are guided by our state. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We attend to the risk high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. Our highly attentive risks determined to take the measures necessary to return inflation to our 2% longer run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions, but such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Right, question time. Look at the dollar.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post.
DXY.
Wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI rate.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So it hasn't changed. It won't change. Is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be.
Sorry, guys. If you'll allow me, because I won't remember everything. So I just want to quickly break down a couple of very important things that have come up. And this is just how we do these live sessions. I want to quickly teach while it's happening so that I don't have to do another video. Number one, we spoke about a neutral rate, or however you spell the word neutral. Right. And that neutral rate is 2.25 to 2.50. All right. Please understand this is the neutral interest rate, right? And the neutral rate that they want inflation to be combated at, right? And they've arrived at that today. Because today they added another 75 basis point, and we already had in the market 1.75 of all the rates. So now the markets, the Fed fund rate is now at 2.5% versus the beast. The beast right now is at 9.1%, right? Inflation, give or take. And they want to bring inflation all the way down to 2%. Now, in an ideal situation, you would want to get your neutral rate because you've pulled down inflation. I hope that makes sense. So the latest question is, well, what's the way forward now? Because you now have arrived at your neutral rate, but your inflation is still, out of control. And he's saying, well, we were kind of aggressive last time to start off by going 0.75, and we kind of are now doing 0.75 again. And if you remember, your first question was, why on earth did you guys just go every basis point, 100 point? So I just want you, I hope we're all on the same page. I hope that's cool. It also gives the video time to rebuff since I've got poor internet tonight. Right, 365, keep it moving.
We see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them for those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So it's very at times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy would respond to, do that, take any estimates of what rates will be next year. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, I would, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done.
The dollars in a supply.
Inflation is coming higher. Economic activity is coming weaker.
Check your stocks.
But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting. But
Nasdaq.
That's really the best I can do on that.
So S&P 500.
Than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of our readings about economic activity and perhaps some geopolitical developments. Who knows? It'll be a lot. It's an 8-week intervening period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on the data.
Hi, Jerry. Thanks for taking a question. Gina Smile with New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question, and we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine.
With this head and shoulder here on NASDAQ,
De-anchoring inflation.
with the first reaction there last week.
So it's something we have to take into consideration.
This is now all Powell today from like London session, New York session now.
CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have two questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point policy? Or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy. You should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect and we think that are probably necessary in order to have to get inflation back percent ultimately. Focus on getting inflation back down. As I've said on other occasions, stability is really the bedrock of the economy. Nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had differences between racial and gender differences, where historic participation was high. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweigh the risks of doing too much. Does that remain the bias?
We're trying to do just the right amount, right? We're trying to have a recession. To bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some.
Yeah, Dr. Francis.
That's what we're trying to achieve. We continue to think that there's a path to that. We know that the path has clearly narrowed based on outside market help. So I do think, as I said just now, that restoring stability is just something that we have to do. There isn't an option to fail to sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
Given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake of doing too much, raising too much, than raising too little?
We're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. Extensive recession. So I don't know. Haven't seen it, and we'll just have to see what it says. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's just that it's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guido with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some Senate.
Sorry, I think let me just pause here and just do with a couple of things. There's one question, and I just want to really touch on this recession thing. So you guys remember before the press conference, I did say this is going to be a very big question for the markets, and we're going to see whether the markets are punishing him for that or not. But there are two types of Powells right now, and you must understand the difference, right? There's political Powell, right? And political Powell works for the United States government. The United States government is currently managing people, managing expectations, managing fear. All right. Now, if you look at basic old school economic history, when there is fear of recession, what happens is ordinary people stop saving money. Right? Stop saving money, stop putting money in banks, etc., etc. And this actually becomes what is known as a self-fulfilled prophecy. So essentially, the fear of recession creates recession because of how consumers react to it. It doesn't help that the economic environment has massive inflation. So already, I don't have enough to save. Already, I don't have extra cash to just sit in a bank. Already, I'm not spending a lot, right? So there's this weird winding down catastrophic thing, right? So there's a reason why governments lie. Yeah, I hate politicians. I feel like they're horrible people, but sometimes the logic that they use is for the better of society according to them. And this is the logic. The logic is if we don't ring alarm bells around recession, we might prevent the self-fulfilled prophecy of recession, right? So that's the political arena. And today, it sounds like today we have political Powell in the house. Then there's economic power. Economical power rather, knows for a fact that yes, GDP numbers get revised. And GDP numbers get revised. In the first financial quarter, the GDP numbers got revised 3 times and it did not change. Q1 was negative. Q2, I guarantee you, I think is also going to be negative. But the fact that he is avoiding answering this question to me tells me that his job, which is technically to be an economic politician representing the United States government, is leaning towards here. They are trying to get ahead of the curve, the fear curve, since they can't tame the inflation. Right. And then the second question from Carlo, I hope I'm pronouncing your name correctly. I think you asked me, what's causing the pump? And by pump, I'm sure what you're referring to this chart. Now, remember at the beginning of my live stream, if you were there on time, Carl, I showed you a picture shared on the live Telegram group. Every time Powell gives these conferences since March, all right, it's either 2 weeks or 3 days, 4 days, 5 days, and 7 days, etc. There is always a gigantic pump in the markets. The pump is short-lived, number one. Please don't forget that. Number two, the pump is simply a reaction to say, well done, Powell, you're doing something, all right? Now, NASDAQ always was going to go up because of the current supply and demand equation. Number one, the dollar, DXY, is in a monthly supply. Therefore, flows are coming out of the dollar back into risky assets. Bitcoin, NASDAQ, S&P 500, US30, Euro USD. You're going to see a similar symmetry of price going up. So that's the main reason. But there is a price target on this chart. NASDAQ isn't going to go up randomly forever. All right. We would like to see a retest of maybe 12,300-ish, somewhere there. And if the 12,300 buy level is very strong, and what Powell wraps up saying, because he's avoided recession. Remember, I said there are 2 types of groups listening today. There's the bulls, commodity confidence, blah, blah, blah. He didn't give them that, but he did say straight up, he said what he said in March. He said, America is not in a recession, and I don't think we're going to go to recession. I think that's a lie, and it's not surprising. I will put out a video this week, I promise you, and show you all the lies they said before the big crash in 2007, 2008. Right, but if NASDAQ does pump, right, I would be looking to see how strong these areas are, right? I feel like there's some unfinished sell business here. I think this head and shoulder pattern has done its job, and prices come back to it. You can see the head and shoulder pattern a little bit more clearly on smaller time frames, right? So let me just quickly go back to press conference so that we don't run behind.
There's a written asking for those rules to have more teeth and to have sort of more transparency about Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, in any comparable institution that I'm aware of. We thought about this carefully, and we put it in place, and we're building the infrastructure that actually you won't be able to make trades unless they're pre-cleared, and the amount of trades you make will be they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really created a very strong and robust set of rules that will support public trust in the institution. And again, we're just now, the system is just now up and running, and I'm proud of what we did.
Katarina Soraya, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what into your thinking for making the decision on how much to raise rates, and just talking about a very large amount that you alluded to, could that possibly be 100 basis points, and then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm going to take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, inflation, policy stance, and I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases. Now we're getting closer to where we need to be.
Same thing with Bitcoin, right?
You know, in terms of September, we're going to watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are by the data. And I think you can still think of the destination as broadly in line with the June SEP. Sometimes SEP is that's what I would say. Probably that where many things to get.
You guys read that? No.
Chris Ruge, FOMC Press. I wanted to ask about, right now there is a sort of growing gap between the Fed's preferred measure of inflation, PCE index, it's public, the CPI, of course. How do you handle this convergence if it starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for the difference. However, over time, they tend to come together. We're given the importance in the public eye of CPI, we are calling it out and noticing it and everything like that. But remember, we do target PCE, that is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we some 20 plus years ago moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned. And a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second. As I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think people widely look at the first quarter numbers and thought they didn't affect the overall direction of the economy. That's true of the second quarter, but at the same time, plenty of experiences where GDP weak and the labor market is strong.
Think that demand is on. You think that the economy should actually be doing pretty well the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter. That is fairly broad. So we'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Hi, thank you, Chairman. Nicole with CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for insurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the employment compensation index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say you and also anecdotal hear much the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was at, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and household survey can be quite volatile, but has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So, executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment. So I think we're going to be looking at inflation as well. We know, as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. But we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of business, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Yeah.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding recession. So how close are we to a recession? And forecasting possible recessions from banks and economists. How does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, there was a little left more.
How did the bank forecast and possible recessions economics? Does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand. You can see that demand coming down in a way that didn't translate into a big increase in unemployment as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's possible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for a couple months now and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimal level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the market should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. So I guess your second question was getting the process of getting back down to equilibrium will take a while. And that time, it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Chairman Powell, Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late, with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways. When we talk about a hot housing market still, just wondering if you find financial conditions tighten enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations. Break-evens coming down, which is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we like to see market-based.
Which market is what?
Expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell. Greg Rock from Market Watch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place, got forward guidance on tapering asset purchases. it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, late to react to some of the decisions of that decision. And have you looked at it in hindsight at all? Thank you.
So, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we rolled out, plenty of people were saying, it's not credible, you'll never get inflation to 2%. Some of our critics who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that it's materially changed the situation, but I have to admit, I don't think I would do that again. We, ultimately the situation evolved in a highly unexpected way for all of us. And, maybe it didn't matter in the end. If you look at, I'm not sure if we've been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates earlier. This is a completely different in the United States.
A lot of people talk about that time they talk about paper, and you haven't. You were in that time about repeating that.
There have been multiple. So there was the famous one in 2013. There's what happened at the December 18 meeting where, where markets can ignore development on the balance sheet and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like, that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, both 13 and 18 really had consequences for the real economy. 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump. Supply side issues would get solved reasonably quickly. They just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time. And so that's really what accounts for the pace at which we moved. And we did when inflation changed direction really in October. We moved quickly since then. I think people would agree. But before that, inflation was coming down month by month, and we kind of thought we had the story, probably had the story right. But then I think in October you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted, and here we are.
I'm Nancy Marshall-Gensler with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow, second quarter, would the Fed consider the U.S. in a recession? And just remind us, what is your definition for the start of the recession?
So the Fed doesn't make a judgment on that. We're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't
we don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and this doesn't seem like that now. Right now, it doesn't seem like that. And the real reason is that the labor market is just sending such a strong signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make. We won't reach a conclusion one way or another on that.
Thank you very much, Simon Marinovich with The Economist. You said that some softening in the labor market is needed. Within the Fed, there are staff economists who argue that NIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of NIRU? Is that something that came up in discussion with the committee?
I think broadly, a lot of economists think that the national rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is there's, it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work, unemployment is so low. I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off inflation, because that's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for the negative slack we have in the economy with the overtight labor market. So if you wouldn't observe this, it's not observable, but you could actually be seeing inflationary pressures come down if that does happen. And we don't control that, but that's something that logically, if the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
Thank you, Chair Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or we're heading for one. Economists pretty much the same thing. They're being told by folks like you and the administration that we're not in a recession, we're not heading for a recession, frankly, coming from the same people who told them that inflation was transitory, telling them now that we're heading for a recession. What would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
Well, all I really say is I don't think it's likely that the U.S. economy is in a recession. I've explained why that is the case. It's because you do see a very strong labor market. The public will see that as well. Going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging, and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that's
has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. For a financial stability perspective, asset values are down, which in some sense lowers vulnerabilities. It's when they're really
Stocks.
that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think
So he's basically saying he likes that stocks are down, like the market has been crashing, because when the market is overpriced, right, then a bigger crash that he can't control or fix is most likely to happen. So when NASDAQ was overpriced at about 14,000, 15,000, now it's at about 12,000. So you get the drift. Bitcoin, 65,000, Bitcoin, 21,000. He's like, yeah, man, now we can sustainably grow better. That's what he's saying. I'm not saying that I agree. I'm just simply saying he's like, look, man, it's working. I like how things are, but kill the demand a bit more.
got a well-capitalized banking system. I think you have households who are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets. So you have from a financial stability standpoint, you have a pretty decent picture. Now, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, we think of that as things that might undermine the working of the financial system. So big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to the grocery store and finding that in many cases their paycheck doesn't cover the food they're accustomed to buying. We're seeing actual real declines in food consumption, and it's very concerning. It's very unfortunate, and that's why we're really committed to bringing down inflation. One of the reasons.
Last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. You can remember when you held your first news conference and you vowed to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape?
Thank you. So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job, it is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people. And we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't want this to be bigger than it needs to be, but ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
Ladies and gentlemen, that's my time as well. That's the end. There's really not much more to add to this. I will be making follow-up videos because I think there's a lot of things to unpack, but I'll be based it more on analysis, supply and demand, some trade signals, etc., etc. So please stay tuned on the channel. I'll see you guys in about 48 hours. Have a good night. Thank you for joining me on this live stream. Don't forget to like, share, subscribe. If you're interested in learning how to trade appropriately, check out the link down below. One more time, shake my hand, everybody. Have a good night. Shake my hand. Have a good night. 365. Cheers. I'm out. Peace.